Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go in and answer a question that someone's asking. It was sent to me through Discord. He's a part of the website, and I wanted to answer it to everybody. Why not? So it's a question about kind of where we're at in the cycle, kind of inflation adjusted. A couple of questions here about some things about the S&P 500, technical analysis, about the potential I'll say bubble psychology that we go through going through a cycle for the herd. So I'm going to answer to everybody. I think it's important to kind of go through these things every once in a while, touch on the real estate stock cycle, look at a big picture view of the S&P 500, look at a couple of ratios to kind of tell you, yeah, this is where I think we're at. No one's going to get it perfect, but as long as you stay on the cheap side of everything, where the valuations are good, if you've got a long enough time frame, generally they work out pretty well. So this is some of the things that I do teach on the website and go over a lot in terms of ratios, technical analysis, and all that stuff. And I'm just going to do this one to everyone just because I felt like doing it. So let's dive in there. Let's take a look. And again, if you guys are interested in joining, it's finding-value.com. And Mayday is the coupon code if you want savings. So let's dive in and take a look at the question. The question is something that's been on my mind and wanted to hear your 2 cents on. While gold has reached all-time highs this year, if you adjust it for inflation, it needs to reach $3,400 an ounce. Is that something you ever factor in? Also, when you look at an inflation-adjusted SPX, it either looks like it's at a double top or below the 2021 high. With that in mind, could you argue we're at the complacency state of this chart? Apologies if all this stuff is super basic, but just curious to hear your thoughts. And nothing's basic, guys. I'm here to answer your questions and ask away. Ask whatever you like to ask me, and I'll try to answer as best I can. So I copied that chart, which is this chart here, and I posted it on the S&P 500 over a long time frame. This is going all the way back to the 1800s even. And you can see the commodity bull markets. When I was looking at all this data, you can see how I charted them out. We're using technical analysis. In technical analysis, when you get these sideways areas, those are known as consolidations. What occurred in those consolidations and what occurred in these leg higher, these impulse move higher between the consolidations? Why do we have those consolidations? Why are they significant? And what can we learn from all of this looking backwards that we can apply into the future? So do I adjust for things on an inflation adjusted basis? I do. The way that I adjust everything is I use ratios. I do not take any sort of man-made accounting metric and apply it to anything. So the consumer price index is man-made. It is adjusted based off of a variety of things, hedonic adjustments, substitution, which makes the number basically unreliable. So I don't use that number. What I use for an inflation adjusted number is actually gold itself. They can't really manipulate it on a long-term basis, and it is a store of value that has held its value over time. We can also price the S&P 500 against oil and other commodities as well. And what you'll see is you'll see the commodity to stock ratio just cycle back and forth during certain periods of time. They cycle upward when the S&P 500 goes sideways. So these are commodity bull markets when it goes sideways. And then when it's out of favor, stocks go and run up between when commodities are out of favor. And there's a reason for it. In my opinion, the reason is the business cycle for a lot of these movements. These were also big expansionary phases of real estate, which drive they drive credit into the system. And if there's any sort of problem on the energy side basis, that is also where it might get amplified. There was an energy problem in the 70s, which amplified the credit expansion because GDP couldn't catch up. That was known as stagflation. We also had a big housing market, bull market in 2000 onward, which also expanded credit into the world having a potential problem with growing oil supply. We did find shale oil. We did expand that quite rapidly, which also created, I think, this big move behind it. We also went into a hyper supply phase of real estate and had a pretty bad real estate crash, which also drove stocks higher from about 2009 and onward. So those are some of the markets here. Now, where are we located on this, the S&P 500? The one thing that's very difficult, and you brought this up very well in your question, is inflation adjusted. And when you look at this, and then you look and you try to apply it to this chart here, and the chart's just basically going up, we don't know if the driving factor behind the S&P 500 is actually productivity gains and additions to gross domestic product, and that these companies are supplying that value to the market, which gives us positive real returns, basically purchasing power gains. And that's what's difficult, because I think a lot of this that we're looking at is actually inflation. The majority of these moves here are driven by inflation. So what we do is we want to price the S&P 500 into, basically against gold. That's how I would adjust it for inflation. So let's do that here. So if I put SPX and I were to divide it by gold futures pricing, we get a different looking kind of chart here. I'll take it off logarithmic because this is a ratio here. So here it is. I put that chart on here as well. So this is SPX divided by gold. It's a inflation adjusted price. And what I see and what it could be, if we were to, I'm just going to make this a line chart real quick. We can kind of gauge where we're at, because this almost looks like a picture perfect chart of this. So one could say that perhaps this down here is kind of the disbelief phase. That's down here at the bottom. So this is disbelief. We've got hope here. This here is optimism. And then we come up, there's belief, thrill, and then euphoria. So euphoria was here at the top. That was 2000. 2000 is the NASDAQ bubble, the euphoria bubble. We dropped quite quickly off that top. We came back up. This is complacency, in my opinion, there. We came down. There's denial here. So that's denial coming all the way down. And the bottom here is anger. So anger is down here. That's what this hump is right there, that hump at the bottom there. Then we came back up, and we've been going through what potentially could be a depression, maybe. So are we going to, or sorry, this is anger. We actually haven't bottomed in depression yet. So that's what we've got there. It's going through the cycle. And where are we located here? We haven't actually hit depression yet. So anger's here. We came back up in this hump there. And I think it's going to roll on over like this and go another lower move here. This is going to be a commodity bull market. Gold's going to go up. Commodities are going to go up. And the stock market is going to go down against gold itself. This is depression. I kind of drew it. So this will be depression. We'll probably bounce up like this. And depression will also be kind of over here. And again, guys, I didn't draw this perfectly. Maybe I should draw it a little bit better here. It'll probably drop in like this, something like that. And it'll be like early 2030s when we hit this or something. And then we'll bounce back up and go sideways like this. It'll create some like pattern that goes like that. And that's most likely what it will look like. This will be the depression over here. And it'll go sideways, just like I drew it in there. And then we'll start that cycle again where we've got depression over here. It'll look something like that. I drew basically the same chart as this. And then it'll cycle back up again on the breakout. Now, that's what's occurring in the S&P 500 when you price it against gold. We're going to get this type of movement. That means gold's going to go up. Most likely, the S&P 500 is going to go down at some point. And I can't tell you exactly when that time is, but I think it will be something similar to what I drew in there. At that same time as we go down, we're going to go through a commodity bull market. If you look at some of the commodities, they're basically at this spot here. If you look at some of the charts there. Another thing is you can also draw kind of a cross here. This is also a double bottom that I just drew, if you were to look. And a lot of commodities are coming up. They're either located on this section here, or they've broken out already in dollar terms up here. So we're entering, if you look kind of the bottoming process here, we're entering the disbelief, aka sideways hope phase. That's that lead-in pattern before the big move higher. We're in this hope phase or disbelief phase in a lot of the commodity stocks. So the cycle, when you adjust it for inflation, you do all these things. Yes, the S&P 500 doesn't look all that great, and I still think that we've got a lot of legs to run in the commodity markets that run opposite of the S&P 500. So this chart doesn't impact all of the stocks the same here. When we go through this, there's going to be, as you come down, this can be financial assets. And at the same time, you can be on the right-hand side over, or I should say the left-hand side over here, where commodities go up during that cycle. And that's why we chart some of the ratios where we chart the S&P versus gold. You can also chart the S&P versus like crude oil, which is energy, because energy also moves with the commodity cycle. So if we look, and I'm going to draw this just the way it is here, but to me this looks like a big double top, and that this will eventually work its way lower over time. We're at a very high ratio, which indicates that energy is cheap and the S&P or financial assets are more expensive. You can also chart it the other way around, which is the crude oil divided by the S&P 500, which is another look at it. Sometimes people like seeing it this way. This was your bottoming in 2000, the big move up in commodities, where commodities and energy outperformed the S&P 500. You can see a clear pullback that occurred in a three-hump consolidation pullback, and that's why I'm doing it this way in a falling wedge. And then if you look on the right-hand side, we broke out of the falling wedge here, and we've consolidated again on top of that breakout. So if I zoom in on the right-hand side, we have another three-hump consolidation that's occurring right now, where we could potentially break crude oil against the S&P 500. And we could come all the way back up to this breakout, and we could even go all the way back up here, which is a possibility. I'm not claiming that's what's going to happen. But to me, this looks like a big double bottom one, bottom two, and then we could come all the way back up, which would indicate a vast outperformance of crude oil and a vast underperformance of the S&P 500. At bottoms, I'm going to look the craziest. When it plays out, it's going to look like I'm a genius. And you have to buy early if you want to get the full cycle, which I did down here at the bottom there in 2020 is where I loaded in. What's difficult is everyone's going to still see the bounces in the beginning. The S&P 500, you break out, and then you get a consolidation. In the beginning, you get the largest pullbacks. That's what like wave one and wave two, you can get a 61%, 70% retracement. People are not going to believe in it in the bull market. That is your disbelief phase. That is what troubles everyone for this. So if I were to go back real quick to the S&P 500 and then come back to this, I'm just going to grab that chart real quick so I can describe what people are going through so you guys can kind of experience it yourself. So when we go through this, as we are down here and we're breaking these things, basically we're down here in the depression for commodities and crude oil against financial assets. You have to price it against something. So when someone says, "Is this inflation adjusted?" It is. It is. It's comparing an asset versus another asset that work well under different market conditions. So when this goes up, this will tell you what market condition you're in because crude oil is outperforming the S&P 500. Conversely, this tells you that you're in a different market condition when it consolidates. Does that make sense? It's all interconnected. And when you go through these, you're going through basically this is the anger phase for commodities. We're down here at the bottom in the anger phase. And we're trying to work our way on up and get out of that depression phase, kind of in that anger depression phase, somewhere in this region over here. Then we'll go into disbelief. This is for the ratio, though. We'll go into disbelief. We'll go through all those phases where people are just going to say commodities aren't going to outperform. There's all these people that don't believe in it because they're stuck psychologically in this euphoria thrill phase for some other companies that are going through that. That's when you get the blow off top and people really jump into those areas. It could be crypto, it could be the NASDAQ, it could be stocks, it could be NVIDIA, which are all, they're riding up here. They are not down here. The best risk reward is buying things that are down. Logically. The problem is you might have to wait a little bit for it to basically mature and start moving. The patience is where you make all the money. You make all the money in the patience. So what I did is everything I do is trying to figure out how can I value the assets in this world? How do I know where the value is at? That's where the ratios come in. And I'm using technical analysis to identify these what I think are perfect entry points. So I'm very heavy into oil equities because of where oil is located against financial assets, which is basically a value adjusted price for oil. And we're, in my opinion, going to enter coming up here over the next decade. We're going to enter a large move in energy against financial assets, which will also coincide with a commodity boom, which will also coincide with gold and precious metals doing very well. That is my opinion. Uh, and I think we're going to see a big rotation of money from financial assets into this. If we do get that big move, you're probably going to see interest rates go up, which we are seeing interest rates going up. We've broken that 40-year downtrend to a rising interest rate environment. That's what we're seeing there. That's what this arrow is. That's what we're broken. So that's also agreeing with my opinion. And I'm trying to grab data from everywhere I can to make that claim to say, yep, we are definitely in that situation. We are coming into a rising interest rate environment. The problem is a lot of people, if this were to pull back and do a retest, they're going to say, well, I'm wrong. And I'm going to say, no, I'm not. I'm just playing it at a different time frame than you guys. So there's going to be pullbacks. Timing the pullbacks are incredibly difficult, but I don't need to win on every time frame. I just need to win on the long time frame. And if I win going out to this spot out here and I make tens of millions of dollars, it just doesn't matter what the short term does. It doesn't matter if we get a small pullback and I go down 30-40% in the portfolio, while then after that pullback, I go way up. Or if we go directly there and it goes straight on up. It doesn't matter as long as I get to where I want to go in the time frame that I want. So everybody thinks that they're going to make all these calls in the short term to get there, and I don't think it's possible to make that many perfect calls all the time. I want to get the general trend right. I want to get in early, like down here. I want to ride it all the way up as long as I can for that big trend. That's where you make the big money. and sit and wait patiently in what I think are the best companies to ride this bull market in. And all of the data that I'm using is in support of that viewpoint. And I'm just going to go up here and show you the commodity to stock ratio as well. That's this guy here. Last bull market, you remember when we were looking at the crude oil to energy ratio, I think that this is kind of like a big bottoming pattern if you were to look at it like this. And we're coming from a very low level in commodities down here. Very, very low level. I think it's a big double bottom. And we've broken the downtrend. There's the downtrend that I'm talking about there. We've broken out. We are consolidating again. And then maybe we're putting in kind of like that three hump consolidation, much like we saw in crude oil. And that's what I'm hoping for. Now, I don't know if I'm right. I don't know on the short term if it's going to, just rip or what's going to happen here. And I'm sure this is very weighted towards energy. So, but the important thing is we've broken the downtrend, step one. Step two is to create a higher low. And then step three is to break through this higher high there. And then we're in an uptrend. So I bought in real early. I'm very patient. The charts are all signaling that we are bottoming in commodity ETFs. And those are other things that I use to gauge bottoms. So this is a double bottom there. This is your ideal entry point. And then we are heading up in COPX. So the problem that most people get, and I'm just going to go back to COPX, is they're trying to play these little movements and predict every little movement. And every movement has a narrative change with it. So we're in the biggest bull market ever. Commodities suck. We're in a bear market, bull market. Oh my God, this is just fantastic. Oh, it's the worst trade ever. It fell back. Oh, it's totally horrible. Oh, it's fantastic. The sentiment is changing on the short term back and forth. I'm not playing that sentiment change, guys. I'm not playing that short term. What I'm trying to do is get in at these buy points here, these what I consider to be ideal buy points, and just sit and ride for the whole thing. And another thing you can do is you can buy these big dividend paying companies that pay you, between 3 and 20% dividend yields. While you sit in it, you're getting paid the entire time, and then you get a break. And then you get capital appreciation, you get dividend appreciation, and you get dividends from, going forward. So if the commodity price goes up, you're getting paid even larger dividends to just sit in it. And you have the capital appreciation as it goes up. Some of these, I'm up a good chunk and I'm getting big dividends in them. So it's the way to play this thing. So I look at all this and crude oil, it's sitting on top of its breakout here. There's the consolidation. There's the breakout there of that consolidation. And this is, I did it on logarithmic. It's not perfect here. And then we're about to break again. A lot of people are giving me crap because when I purchased this, I purchased it really low. I bought it here. And then I've been holding it the entire time. And then, people are going to say, well, why didn't you sell it here? Why didn't you buy it back again there? I didn't know that was going to occur, guys. I didn't know how big of a pullback. I didn't know that they were going to release SPR barrels. I didn't know any of that stuff. And no one's going to capture those tops and bottoms perfectly. And you're going to have a pretty big pullback in the equities. Now, some of the equities during this time frame of this pullback, they went up a lot. Some of the equities did. They didn't pull back like oil did. So you can't necessarily state that you would have nailed that because you would have missed it. Some of them went up 100% in 2022. Some of the equities did, and some of the energy service companies did too, 80, 90% in a single year during this pullback. That sounds weird. So when we break this, I'm going to be in it. I'm going to be sitting in it. I haven't paid really any taxes or anything like that. And I think this is absolutely fantastically positioned. So I know I kind of went off the rails there explaining some of this stuff, but like to be patient and to kind of block everyone out and then look for the big cycle move, that's where the big money's made. And in all honesty, guys, I'm going for multi millionaire. That's what I'm going for. And I don't need to make the small little movement gains. which are riskier to try to play because the long term is priced off of these big cycles. It's the real estate cycle that I found, and that real estate cycle is applying pressure to the system and to the herd. We can see that pressure being applied through technicals. In the short term, the fundamentals aren't driving the short term necessarily. They can be and they cannot, they might not be. That's more emotional driven. It's more people trying to play the short term, getting scared, fear, all of those things. And that's where people get messed up. They get afraid when they see a pullback. They start to doubt their allocation. They start to doubt that the bull market is still there. They may think, oh no, a recession's coming, and then you get a sentiment shift. So you get sentiment shifting from positive to positive in the short term. And on the long term, the fundamentals are driving all of this. They're driving the herd to behave a certain way. They're driving inflation in the system, either from the supply side or the demand side of credit expansion. And then we use the big patterns, like we've got crude oil here, the big patterns to gauge um, the breakout here of the consolidation zone. So if you break the consolidation zone and we basically consolidate on top of it, this is a huge pattern for just a big break to the upside with time. So, I mean, inflation adjusted, yes, I adjust everything through ratios to take out the value of the dollar. I want to see what the value is priced in other assets. So that's what I mean by inflation adjusted. That's how I do it. I overlay cycles on top of it. I overlay the technicals. I overlay what the herd is doing, what I think it's doing. And then you'll come up with what I think is a clearer picture of where we're at in the cycle. And in my opinion, we're still early in this cycle and we haven't made the big moves yet. And the reason I say that is, or one of the reasons, is that commodities haven't made any progress against financial assets. And every time we've had a big commodity bull market, they've made a lot of progress against financial assets. So it makes me think that the commodity bull market, may have had a first leg, which was the stimulus money that came into the system. That might have been the shock to the system that got the commodity market to wake up. But we haven't gone through the big show yet. We haven't gone through that big extension higher where we've got credit coming into the system, which we do. We're in an expansion phase of real estate. We've got fiscal spending also driving some of this. So it's a combination of those two things. And the supply side hasn't hit yet, I don't think, in a lot of these commodities. They will in the later 2020s for sure. A lot of them like copper, aluminum, oil, nat gas, I think is going to come under pressure at some point to really expand production because of the demands for electricity, and also it's going to be weather dependent too. But I think all of that is kind of overlaying on each other. It's all stacking up. And I don't think we've got the big move yet because financial assets are still very expensive in relationship to commodities, energy, etc. That money hasn't rotated as much as what it has in the past. And some people will say, well, you don't know for sure that it's going to rotate. You don't know for sure XYZ. It's like, well, it's not about knowing for sure. It's not about making the most accurate predictions. You only need to ride this thing once or twice in your life, a few times, the big moves. So if you catch a bottom where there's a big market sell-off, a recession, and you catch a bottom in some of these companies, technology companies or whatever, and you ride it for one full cycle, that's all you need. That's all you need. Commodities are the same way. You catch it at the bottom, you ride it through one full cycle. You don't need to ride anything else. The returns are so big, and it's so rare for people to ride that full cycle that you don't need to catch really anything else. Some of these companies will go up 100 times. Some will go up 20, 30 times. That seems to be a good chunk somewhere in there between 20 times and 100 times. A lot of companies fall within that. And you're not going to catch bottom to top. So you're going to have to maybe, divide it by two or something. So you'll catch 10 baggers, 20 baggers, 30 baggers, or something like that. And you just kind of have to know where you're at in that psychological fact sheet that we saw in the beginning, market psychology sheet. If you can buy in the depression and just wait for that cycle to come, you only need to catch one cycle. But obviously, I'm going to catch more than one cycle. I'm going to keep playing it over and over, not with all the money. It's not a casino where I'm going to put everything on red, shift it to black when it changes. I'll put a lot of money on it. I'll put it, and I'll keep putting some money on it, using different strategies, buying undervalued assets and waiting for those assets to become overvalued. And then using technical analysis to kind of gauge where we're at, what the herd's doing, how it's lining those assets up, and then taking and placing my bets across the board, winning with these large asymmetric bets. I don't need to win on everything all of the time. I just need to win on some things some of the time. And that's where the symmetry will carry the whole portfolio on up. And then you just do it over and over and over and replicate the strategy in different market conditions. And if you can identify anywhere near the bottom, buy if you've got the courage, and then ride it. That's it. That's it. So yeah, the S&P 500 doesn't look that great against gold. It doesn't look that great against energy. And where do you think I am? Where do you think I'm located? I'm in precious metals, and I'm in energy. Here, we'll do one other chart here before I go. So here's silver divided by the S&P, the SPX. And what are we doing here? So what I see here, I'll put on logarithmic just to expand it a little bit. Remember that chart that we had, and remember double bottoms. So I'm just going to draw this across here. Usually you get kind of like a lead-in pattern. It goes into a big depression kind of. And I think that we are putting in a double bottom is what I think we are doing. And I think that we have broke it here recently, the downtrend line there. So this is your big double bottom. I think that's going on. And we've just recently started to break to the upside here for silver. And silver is going to, in my opinion, probably outperform gold. So what I look for are these large asymmetric opportunities where, and I'll just show you here, this is the S&P 500 divided by gold. Remember, we just looked at that. That's this guy here, anger and all that stuff. And probably it's going to, so this is gold. Gold's going to outperform and bring it back down to a double bottom. At the same time, we're going to have the gold to silver ratio, I think. It's broken to the downside here. You see that downside move? I think we are going to break downward, where silver's going to outperform. And then again, I look at the charts over and over and over. So this is silver, which silver, if you look from the big picture view, this is your cup and your handle. We've broken out of the handle here. And then if we back out, the projected move is all the way to 300 something dollars if we get that big breakout. The problem that people have is they think it's just going to go straight up there. This is going to be a big bull market, guys. This is like once in a lifetime opportunity. We could get a retest like that. So what? Don't lose focus of the big picture view and where you want to go in the future. So I think that this is could easily get up there, and I don't know the time frame, like the exact time frame of this. So that's what I focus on. I focus on the long term. I focus on these big picture view charts, and I am going to go for it. I think energy's absolutely fantastic. I think silver looks absolutely fantastic. I think platinum looks absolutely fantastic. They all look good. So what I do is spread across, be patient and wait. And I've made good money doing that approach. It doesn't mean I'll be right all the time. It doesn't mean I'll be right in the short term every single time. I try to time my purchases as best I can. It is difficult. So what I do is I have strategies to enter stocks, generally cost averaging in at certain areas. And that's exactly what I show on the website. And you can see when I'm entering stocks, when I'm entering even physical metals. And I don't really sell much. I kind of just accumulate cheap assets and then let them go. Let them go and ride the wave. Enjoy the ride as well. So, but that's what I've got for today, guys. And hopefully this inflation adjusted, really I price it's asset adjusted ratios that I do to figure out where the value is in the market. And then I price it in terms of dollars too, as well, like I have silver in the background here. So, but that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel if you like. If you want to subscribe to the website, you can do that with Mayday. We do have a question and answer session coming up Sunday at 5 p.m. As a reminder, it did change. We were going to have it Saturday, but there's stuff going on all day. It's going to be this house. It's going to be way too loud. So Sunday, 5 p.m. will be a great time to have it. And yeah, hopefully everybody's doing well. So we'll catch you later. This is Finding Value.